Good afternoon, everybody, and good afternoon to our clients and our guests. We are quite privileged this afternoon to be joined by Dr. Rashad Cassim and Kevin Lings. For those of you who don't know, Dr. Cassim is a member of the Monetary Policy Committee, and Kevin Lings is Chief Economist at Stanlib. Kevin has spoken at many of our previous investment conferences, and clients enjoy having Kevin speak. He's one of the few economists that they can understand. So, guys, thank you for your time. We're really excited to host this particular webinar. You may recall last year we had a webinar where we hosted Kuben Naidu. Kuben is one of Rashad Kassim's colleagues, serves on the Monetary Policy Committee with Rashad. And Kuben kind of left us with a kind of a fairly clear message, bearing in mind that not only is he a deputy governor and a member of the MPC, but he's also the head of the Prudential Authority. So essentially all the banks report into Kuben. And his message was clear last year. His message was at the Reserve Bank, they have things under control. What they need to have under control, they felt they did. The banks were in a good position. They were financially sound. There were certain interventions that they had taken. They injected a bit of liquidity into the market, and interest rates had been slashed quite significantly by that time. And the message was that we would see the benefits of those lower interest rates coming through and supporting the economy. I think what we weren't clear about at the time when we were talking to Kuben was just where fiscal policy would land. And, with the understanding that South Africa went into the COVID crisis in a fairly poor fiscal position, we didn't seem to have much room to maneuver from a fiscal position. The president then came out with the 500 billion rand stimulus package soon afterwards, and there have been, kind of mixed views about how supportive fiscal policy has been. So just for the benefit of our clients, we're going to talk about monetary policy and fiscal policy. So just for, kind of bearing in mind that we have sort of lay people in the audience, doctors, accountants, lawyers who don't necessarily use this terminology on a regular basis. Monetary policy and fiscal policy are two broad kind of policy frameworks that any economy has to support the economy. So monetary policy is really about controlling the amount of money in the economy and with a view to controlling inflation. So ultimately, the role of the Monetary Policy Committee and the authority overlooking monetary policy is to ensure that inflation doesn't get out of control and that the external value of the currency is protected. Fiscal policy, on the other hand, is about government revenues and government spending. So, how they support an economy by the decisions they make in terms of how they spend money, where they spend money, and how they tax the citizens. So when you hear monetary policy, the easy way to remember what monetary policy is would be to think about Lesetja Kganyago, who's the head of the Reserve Bank, and what he kind of speaks about and what he focuses on. When you hear fiscal policy, think about Tito Mboweni, particularly on budget day, and the kind of issues that he would focus on. So today we're going to take a look at the broader economic status quo in South Africa. So we've been through quite a lot in the past year. As I said, the economy was on its knees before the COVID crisis became became a very real crisis for all of us. So where are we now? What does South Africa's kind of economic position look like at the moment? So the format of today's presentation or today's webinar will largely be a discussion between myself and our two guests, Rashad and Kevin. I'm going to then open it to the floor and ask or get questions from the audience. If you move the mouse on your screen, you should see a Q&A button at the top. So what I would like you to do is just submit your questions using the Q&A button and not the chat button. Okay, so any questions you'd like, pose them through the Q&A functionality. And then, yeah, we will open it up for questions in the end. So, Rashad, if we could start with you. You're kind of fresh out of a 2-day Monetary Policy Committee meeting. And I think for the first time in many years, I know how you voted. And that's only because the decision was unanimous. So a unanimous decision to keep rates unchanged. Can you give us a sense of what the discussion points were, the key discussion points were in the recent Monetary Policy Committee meeting, and kind of, how you guys are seeing inflation in particular? I think many people are a bit grumpy that inflation's below the 3 to 6% target, and there's still no room for further interest rate cuts. So if you could just give us some insight into the meeting and the discussion.
Thank you, Craig, and it's a pleasure being in your webinar. Look, I think that, firstly, let me just say that you, as you rightly say, as a central banker, we kind of stay clear of fiscal policy issues, and the Treasury stays clear of monetary policy issues. But at the end of the day, any fiscal policy decision is it has implications for monetary policy, and any monetary policy decision has an implication for fiscal policy. So you have to see the two as integrated. I think that the real question, as you rightly put, that many people have been asking is, that the central bank was very bold in bringing down interest rates considerably by 300 basis points, depending on what your starting point is. And I guess the question, as you rightly put it, is, we have an inflation target of 3 to 6, and the midpoint is 4.5. And why is it that despite inflation being where it is, the scope for more cuts seem to be somehow limited, or at least until this meeting, there's been a debate, and a few members wanted a cut and others wanted it unchanged, and there was some unanimity in this meeting. So I guess it's got to do with the fact that in the way you think about the monetary policy instrument is when you use the instrument, whether you're going to increase the interest rates or decrease the interest rates, the effect you have is not today. You cannot influence or have an impact on inflation today. You can only have an impact on inflation, going forward, maybe a 12-month or an 18-month period. And as a result, it is very, very difficult to think about today. What happens today is not irrelevant, but it's almost it's the starting point. So if inflation is 2.9%, as we saw yesterday, we make an assumption that the 2.9% is very specific to current circumstances. But given the long run, given the fact that interest rates make an impact on the economy only 12 to 18 months down the line, we worried about, will the 2.9% go lower or will the 2.9% go higher? Obviously, by keeping it unchanged, we're making the assumption that it'll go lower. If we were confident that it would remain at 2.9, if we were confident that it would go in the downward direction, you could get another set of hikes. So, but we may be wrong, but we think unlikely. I think the big debate is to what extent will the inflation be around the midpoint of the target. Now, our forecast shows that, we think inflation is going to be 4.3 for this year, 4.4 for next year, and 4.5 for the year after. And so I think that the question here really is that are we wrong or are we right? Now, one of the reasons why there was unanimity in this meeting was simply that, what we wanted to convey to the public and to the analysts and to decision makers is that we think, our peers like Brazil recently hiked its interest rates. So did the Russians, so did the Turks. But I think that you have to look at their specific circumstances. Brazil, for example, has an inflation target of 3.75%. Its inflation is currently at 5.2%. And it's not confident that it'll be able to keep its inflation close to the target or within the 1.5% range either way. So Brazil hiked because it felt that it's not going to meet its inflation target. And the question we face, but if Brazil is hiking, is it a new dawn? A country is beginning to hike suddenly. And our view is that you have to be really, really careful. You have to be careful because you've got to understand most of the countries we're talking about have an inflation target. You've got to understand where the economy is, and you've got to understand what kind of cuts or path they followed before this decision. And that is why we almost want to convey to you that we want to live with lower for longer. That it is unlikely that we're going to see a massive increase in interest rates unless the risks we talk about materialize. Now, one thing that's different about this meeting relative to the last meeting is there were a few things. One is that electricity prices seem more of a risk. Oil prices seem more of a risk. And I think the global economy, particularly with rising yields in the US and other countries, also put more pressure on the exchange rate. So we worry about the exchange rate and what impact that could have on inflation. Let me leave it in that, and we can continue the conversation.
Okay, thanks, Rashad. So I take the message then is that you're more interested in the path of inflation going forward as opposed to where inflation is today. And kind of where inflation is today probably was impacted by some of the decisions that you guys have made in the past. I think, it's a two-edged sword with interest rates because you have your indebted population who would love another rate cut. And there you have those who rely on interest income who would prefer to see rates go up so that they can earn a higher income from their investments. I think at this point, I'm going to ask Kevin. Kevin, you sent through some interesting slides where you looked at, kind of the unfolding situation around vaccine rollouts and kind of the global economy and kind of where we are with COVID. Can I ask you to share your screen and maybe talk us through some of the more interesting? You can share your screen. Okay, fantastic. So Kevin, I'm going to hand over to you and you can take it.
Sure. Thanks, Craig. Afternoon, everyone. Okay, I just want to touch on a couple of points. I'm not going to go through a whole presentation. I just want to make a couple of kind of key highlights. First, around the vaccine rollout. It's very clear to us that while some countries are doing quite well, and you would flag, I guess, the UK, Israel, you would flag the United States, and then some smaller countries, Seychelles is doing exceptionally well with vaccine rollout. So while some countries are doing well, the vast majority of countries in the world economy are struggling. It's not just South Africa. Obviously, South Africa is having to revise the sort of expectations about when we might reach some sort of population immunity in terms of the vaccine. But if I look at the core of Europe, it looks messy. Many other smaller emerging markets, I think, look messy. That doesn't mean that's what you want, not at all. But I'm just trying to highlight that this is a difficult process for most countries to try and firstly procure vaccines and then disseminate them. The other thing that is fairly clear in the data as far as I'm concerned, and that is that the vaccines work. When we look at the data out of Israel, when I look at the data, not across the entire United States, but in specific parts where they've had much more success in distributing the vaccine, it's clear to me that it works and that the infection numbers come down, the hospitalization numbers come down, the death rates come down. So I think that this idea that we will eventually get to population immunity and that the world economy will open up much more fully, I'm 100% behind that. But I think we've got to be realistic about when that's likely. And you would now say during the course of next year. Some countries this year, the US, I would say by the middle of this year, possibly the UK, Israel slightly before that. But then other countries later this year, and the bulk of economies only next year. And it's also quite clear that you can't have a situation where just one or two countries are being successful. All of the economies have to be successful. It's in the interest of everyone around the world that this vaccine rollout is successful. So let me just show you some of the numbers that have done well. This is the number of vaccines being administered in the United States, and the number's now over 120 million. Which you would say is quite impressive given the way that Trump approached the whole COVID story and to some extent the vaccine. And right now, the US is able to increase their vaccines at an average of somewhere between 2 and 2.5 million a day. And it doesn't take you that long at 2.5 million a day to reach population immunity. So you could then project, at least by the middle of the year, as things go at the moment, the US should be in a much better position. And as I say, parts of the US are definitely already seeing a huge benefit. When it comes to Israel, they've given the vaccine to roughly 60% of their population. What is interesting is that when you get up to these sorts of percentages, 60% of your population, it becomes more and more difficult to go beyond that because there still seems to be a general reluctance. I know that in Israel, for example, it's something silly, but they sent healthcare workers to nightclubs. The idea was to entice people to take an injection, a vaccine injection, as pay, and then get a drink as a kind of payment for taking the vaccine. It's resorting to those types of tactics in order to administer these vaccines. So I don't think it's a straight line that you go to population immunity. I think it's going to become more challenging as you reach more and more of the population, but it's possible to get up to these sorts of numbers. And as I say, other countries have done just as well. When you look at Europe, though, the numbers are going in the wrong direction. Italy's in lockdown, France, they're key, Germany's struggling. The infection numbers have picked up in many European economies. They're not able to get the vaccine rollout all that effective. And I think it's going to take them a considerable length of time. And it's no surprise their economic data is actually disappointing right now, especially internal within Europe. Their export data looks okay, but inward within Europe, really struggling. So I think it's early days in terms of this vaccine initiative. I think we've got to be realistic about what's achievable. South Africa, our infection numbers look okay. I'm using a 7-day moving average. It's around about 1,000 a day, and that's fine. But we are concerned that we're going to have a third wave. In fact, we've built a third wave into our forecasts. We've assumed that materializes during the month of May. But we are hoping that it doesn't become as substantial as the second wave, nor do we think the lockdowns will be as significant. But it's a clear risk. And in terms of our administration of vaccines, We're touching 200,000. And clearly we're behind. We would want these numbers to be a lot higher, but we've only got so many vaccine doses available. A lot more are going to be arriving during the second quarter of this year. So I think we're going to step this up. But when will South Africa reach population immunity? You've got to say at best the first half of next year. And I think we'll make much more progress in the second half of the year, but I think we've got to factor that in. The other thing I just want to shift, if I can, Craig, to talking about how fiscal policy has impacted economies differently and the choices being made. And I just want to contrast what is happening in the United States versus South Africa's choices. So I'm going to flick over a couple of charts. So the US has introduced phenomenal fiscal stimulus. There's no other way to describe it. They've gone through a couple of stimulus programs and they've just approved another huge fiscal stimulus, 1.9 trillion. More than half of that is going to go to households. And there's also no doubt that this massive fiscal stimulus is beneficial to the economy. It gives you a huge boost in economic activity. And a lot of the stimulus in the US has been directed at the household sector, specifically at consumers. And we know that US households have received this money from governments and spent the money. Some of it has been saved, but the huge majority of it has been spent. And that it's beneficial, absolutely gives your economy a massive boost. Now, I want to show you how big it's been, how significant it's been. And I'm going to come back to the growth forecast in the US in a sec. But the first thing is have a look at how much money the US government has been paying in unemployment insurance. This is monthly data. Now, go back to the chart in 2009. That was the global financial market crisis. And obviously, a lot of people were unemployed at that time, and the government provided support to the population. But now contrast that with the level of support that has been provided in the last year to the population. It's completely different scale altogether. And this excludes the latest huge stimulus, 1.9 trillion. So there's no doubt that the US government has taken the decision to very actively not just support business, not just support households, but make that support very tangible, very real, very immediate. And so the consumer gets money very quickly and is able to deploy that money. The latest stimulus, besides increasing the regular unemployment insurance, the US government is going to be sending qualifying people checks for $1,400. Now, not everybody's going to receive that check. You have to be earning less than a certain amount, but it's a significant number of people that will qualify. And so already those checks have been posted. The system works very quickly. And it's a check per household member. It's not for one household. It's $1,400 for every person in the household. So if you are a husband and wife with two children, the two children also get $1,400 each, which means suddenly that household is going to be getting over $5,000 that they can do anything with. And they've been getting this type of stimulus all the way since May of last year. And as a consequence of that stimulus, what did the consumer do with that money? In essence, the consumer went shopping. So in the US, consumer spending is 71% of the economy. Think of the US as one big shop. And what the government has done is in effect paid people to go shopping. And it turns out that when you pay people to go shopping, they go shopping. So when you look at retail sales in the US, it's back at an all-time high. It went down sharply in April. You can see on that chart, a huge fall off during the lockdown. And at that point, obviously, all economies negatively affected. But then they started to send out the checks, and they followed that up with more checks. And as those checks have arrived, the consumer has taken it, cashed the check, and gone shopping, driving US retail sales to a record high, and therefore driving the economy into a recovery that we think this year will be probably actually around 6% or even higher GDP growth. So it works phenomenally well. And it doesn't mean that employment has gone back to where it was. In fact, US employment is still 9 million jobs below the previous peak. So it's not as if the stimulus immediately helps with employment. It obviously helps, but it doesn't close out the gap. There's still a huge number of people unemployed. This is an artificial stimulus, get people out there, get people shopping, drive the economy higher. Now, how the hell does the US pay for this? Well, they can't afford it. No government can afford this type of stimulus. So what is happening in effect is that the US government is simply spending the money, so you can see the pattern for government expenditure. It's almost gone vertical. Government tax revenue in the US has gone kind of sideways. But clearly the US doesn't really mind that, right? Which means that their budget or their fiscal deficit is enormous, double-digit % of GDP. And there's no doubt that if we did this in South Africa, all hell would break loose. You can imagine what the press would do if we tried this type of stimulus, let alone what the credit rating agencies would do, what a whole lot of investors would do. So how is it that the US can do this? Well, quite frankly, it's because it's the US. Because when it comes to the US, different parameters are applied, different measures of what is acceptable. And you can say that's right or wrong, but that's the reality of the world we live in. So when we show this chart, people say, oh, it's okay, it's the US. But it means fundamentally the US is now massively more indebted. So what is their total debt level? It's over 100% of GDP. And we are screaming because our debt level has just gone over 80%. The US is pushing it over 100%, and it seems okay. It's because it's the US, and you trust that in time, this will ultimately work and lift the economic growth, get employment, and that ultimately they'll resort to better fiscal management. So different rules being applied to different economies depending on a whole lot of things, including the history of the country, right? Now, the US has a major benefit. And the benefit is that the Federal Reserve in the background has been willing to create money balances, electronic balances, use those electronic balances, and a significant portion of those electronic balances have gone into the purchase of US government debt. In other words, what you got to say to yourself is the US government is a hell of a lot more indebted. Who is funding them? And it turns out that a big portion of that funding is coming from the Federal Reserve. And the US Federal Reserve now owns almost $5 trillion of US government debt. How did they get to afford $5 trillion? They don't. They simply create the money, call it quantitative easing. Obviously, if it was in Zimbabwe, they would say printing money, but it's quantitative easing. And they've taken that money and bought $5 trillion of US government bonds. And so it helps enormously with the government's ability to provide the stimulus. So many people then say, okay, well, why doesn't South Africa do this? Why don't other countries do this? And clearly it would be very tempting. But in South Africa's case, and Rashad would be able to comment more fully, but in South Africa's case, if we tried to do this, in all probability, the currency would weaken dramatically, we'd end up with hyperinflation, our credit rating would fall, and we'd have all kinds of other fallouts as a consequence. So why does the US get to do this? Because they have the dollar. And even though the US has effectively created so many more dollars, the world still loves the dollar. The dollar remains the reserve currency, and the US is using the power of the dollar to their benefit. It's great if you can do it. Now let's flick over to South Africa and see the constraint. I'm going to flick through a whole lot of charts, but hopefully you'll see what I'm getting to. Oh, sorry. I'm just skipping through to South Africa's fiscal position. Okay, so when you look at South Africa in terms of its level of debt, it was manageable in 2009. It was 26% of GDP. Phenomenal. South Africa, people forget, in 2009 was an A-rated country by Moody's. Moody's gave us an A rating. Trevor Manuel had spent a huge amount of time getting government debt down from 50% to 26%. And then we changed regimes within the ANC. And as a consequence, government debt went in the wrong direction. And now it's gapped even higher because of COVID-19 and the fall off in tax revenue. And so we find ourselves with a government debt of 80% of GDP. We find ourselves with an interest cost, the interest cost of government debt over 20% of government's tax revenue. And as a consequence, Tito has no choice. He's got no option. What he has to do now is he has to say, guys, I've got to be disciplined. This is out of hand. I've got to control the debt. I can't continue to spend the way we have in the past. So there's three areas that the government has to focus on now. The first is the government has to slow down the increase in the salary cost. And this is the budget that the Minister of Finance has put out in the latest numbers. Now, historically, look at how much of an increase was coming through in government salaries. That was fairly substantial and well above inflation. But going forward, the minister's saying we can't do that. We can't afford it. And clearly, there's no doubt that this is going to result in a labor market dispute between the public sector unions and government. And it's going to be key to see whether government's got the political will to fight this, to stick to this, to say this is what we've got to do in order to restore fiscal discipline. And clearly, if they give in on this, while it might be beneficial in the short term in terms of economic growth, it'll be hugely negative in terms of foreign investor sentiment, the credit rating, and all kinds of things. So the key challenge right up front is, can government control the salaries? The second key challenge government has got, that is that in the background, municipal finance is shockingly weak. Revenue collection in municipalities is dwindling. That's got a lot to do with a culture of non-payment. It's got a lot to do with the weakness in the economy and the high unemployment. And you can see systematically over time, the amount of money outstanding for municipalities keeps rising, and the amount of money outstanding by municipalities to pay suppliers keep rising. Now, this doesn't fall into the ambit of Tito's national budget, but it's not something government can entirely ignore. And so the service delivery protests are becoming problematic, services in various municipalities problematic. So it's something that government's got to address, and clearly there isn't the money to address that in a really rapid way. And then the third issue that government's got to deal with is the
one more minute,
sector.
Kevin.
Yes.
That's another minute, and then we'll take the conversation forward.
So look at the fixed investment out of SOE since the Soccer World Cup. It's been pretty much negative. And this is what drives South Africa's infrastructure. And we know that the SOEs have wrecked their balance sheets. And as a consequence, there hasn't been the level of infrastructure development needed to develop the country. So South Africa's in a completely different fiscal position. We would love it if government could support this economy and help to grow the economy, but they don't have the financial latitude to do that. In which case, a lot of the emphasis then falls on interest rates and monetary policy. From our perspective, monetary policy has done the heavy lifting. It can't do much more than it's doing at the moment. In order to move the economy forward, we've got to get government discipline under control. We've got to partner between government and the private sector to drive infrastructure, private-public partnerships. We've got to improve the administration within municipalities and thereby lift confidence in the private sector. We start to move in that direction, and I think we've got a meaningful uplift. Fiscal policy in South Africa now is constrained by the historical baggage that the government is now dealing with.
Thanks for that, Kevin. I think the one kind of shining light for South Africa from a fiscal perspective has been revenue collection from the mining and resource sector in particular. And I think that bailed us as taxpayers out in our personal capacities, in that we didn't have to endure a tax rate hike in last month's budget. How long do you see that lasting? I mean, can that last?
Our feeling is that the commodity cycle seems solid. It seems well supported by the rebound in global growth, including restocking and inventory accumulation. I think our mines are moving into a better position to benefit from that. There are still some bottlenecks in terms of infrastructure and mining capacity, but I think we've been surprised by how quickly it's responded, and I think it will be sustained. And there's no doubt that has been a huge benefit for tax revenue, and certainly helped to lessen the damage that COVID-19 incurred. And it's one of the factors that makes us more confident that we'll at least get growth. We're saying over 4% this year is the rebound in commodities and mining. So I think that South Africa is in for at least a 2-year phase of above trend growth, partly to do with base effects and the commodity cycle, and then partly to do with pent-up demand as you open up the economy after you've delivered the vaccine. So I think the good news is that we're in a phase for better growth. What we've got to watch for is, in the background, while we're rebounding, in the background is enough work being done to give us sustainable growth in the outer years. Are we dealing with SOEs, partnering with private sector, dealing with municipalities? That's what we're watching. So I think the outlook for the next 2 years, good, helped by the vaccine, but we need more work for the outer years.
Yeah. Rashad, if I can pull you in at this stage, the conversation globally is around global inflation. And, with some of the stimulus that Kevin's spoken about, to what extent are you guys concerned about global inflation? Do you buy into the thesis that there is going to be a global inflation problem coming our way?
Yeah, I mean, so the main country where global inflation is a subject of discussion is the US. Now, what is interesting is, as some of you may know, that there's been this direct contrast between emerging markets and advanced countries. In advanced countries, the problem is that they can't get inflation up, that they have deflation, they have a problem. The central bank is almost becoming inefficient in getting inflation up. And why is it that you want inflation up? To have deflation in the economy is almost as bad as having excessive inflation. And the main reason is that if you're a consumer and you know that your product today costs $10, but the product tomorrow will cost $9, or the day after or the month after, you'll simply stop buying in anticipation that you'll get the product cheaper much later. So the challenge in many advanced countries has been getting inflation up so that you can get, there's good deflation. The price of mobile phones come down because of productivity and innovation and so on, but there's bad deflation too. Now, the question about inflation going up in the US and other countries is an interesting one. They have an inflation target of 2%, and they've always been missing their target. They've changed their framework where they're allowing a process where the average inflation targeting, where they're saying, we have very happy to be at 1.5% for a couple of years and 2.5% for a couple of years, and it's the average that matters. Now, one of the things that many countries worry about is the central bank printing money, and that's leading to excessive inflation. So for those of you who don't follow this very closely, there are two ways in which central banks today are stimulating the economy. In our case, because interest rates are moderately high, we can use interest rates. So we came down from 6.5% to 3.5%. We can use interest rates to stimulate the economy. But in countries like the US, Japan, Europe, where interest rates we're almost at the zero low bound. When we say zero low bound, either 0 or 0.25%, 0.5% or 1%. In those countries, they had to use their balance sheets. They had to rely on their balance sheets. And in 2008, when the US pumped in massive money into the system by buying assets. People thought there's going to be inflation. Many people projected inflation in the US, but in the end, inflation didn't happen for the simple reason, and that is that although what we call the monetary base is notes and coins in circulation, and the amount of reserve that sits, amount of bank reserves that sits in the commercial bank reserve that sits in the South. And the monetary base went up. But the moment the monetary base goes up, what you expect to go up is massive lending to the economy, people buying things. So the monetary base goes up, and in the process, what we call M2 money supply goes up. That didn't happen throughout the financial crisis in many advanced countries. And there were a number of technical reasons for that, which I'm not going to go into now. The main reason why there's a concern about inflation or reflation in the US today is that the scale of their quantitative easing is more open-ended, it's more bold, it's bigger. On top of that, you've got this 1.9 trillion that Kevin talked about. So there's a view that the US economy will overheat. Now, overheat means maybe, and this is the big debate, will US inflation go to 2%? Will it go to 3%? Will it go to 4%? Or will it go even higher? That's the big debate. What does it mean for us? Number one is if the US economy sees more inflation, the inflation differential between us and those countries, narrow, and that's a good thing. That we retain our competitiveness because the inflation differential has narrowed. The negative thing is that once those economies start pumping and their kind of yields go up, asset managers sitting in advanced countries will be less desperate to search for yield in countries like South Africa, but will be searching for yield in countries where the growth prospects are greater, not only in the bond markets, but in the equity markets. And that is why, it's kind of a mixed impact. It's good that the US is growing, it's good for our growth, it narrows the inflation differential, but at the same time, it could add more volatility to our exchange rate. Thank you.
So is your view, are you buying into the thesis that inflation will go up, or are you sitting in the camp which says that, the inflation will kind of peter out?
So think about it. I can't remember what U.S. growth was in 2020. Can you remember, Kevin? I can't remember. But anyway, it was some -4, -5. But they expect growth to go up to 6%, 7%.
It was -3.5.
Okay, so they have growth to go up to 6-7% this year. And if you think about it, the economy is going to overheat and inflation will go up. The question really is, will it be just inflation going up temporarily, for 2021 to 2.5% and maybe comes back? I think that's a more likely scenario. Others are more cautious. Others think it could go up to 3%, and it may be difficult to rein it in. I don't think that's a problem.
Okay. And then just the last one for you, Rashad. The other issue that you focus on at the SARB is exchange rates. Now, I think South Africa surprised many market commentators and players this week with the kind of sheer resilience in the currency, given what happened in Turkey with the Reserve Bank governor being fired. Can you give us kind of some sense of where you guys see the currency going, and why is it that South Africa didn't kind of get impacted this time by what happened in Turkey?
So let me just start off by saying that most of the people who invest with you in Gradidge Mahura investments should be aware of the fact that the last people they want to ask about where do you think the exchange rate will be going are economists, because we don't have the tools to determine. What we can do is we know from historical relationships, certain things drive the exchange rate in either direction. So Kevin talks about terms of trade and the commodity boom. We know that an increase in commodity prices can lift up the exchange rate. We know that if very bad news comes out about maybe the current account balance, it can drive down the exchange rate. If the US is loosening more, it can drive down the exchange rate. So I think that one of the things that our research team in the bank say to us as MPC is that a large part of the improvement in the currency is externally driven. It's not because South Africa did something miraculous that its exchange rate or its currency is resilient. It's often 75% of the determinants of your exchange rate is what happens globally, what happens with the VIX index and so on. But I also think that, and I really am reluctant to kind of blow my own trumpet, but I do think that, when there was this massive reaction to the Turkish lira, smart investors realized that, the SARB is a totally different animal to the Bank of Turkey. That, it's that the SARB Act, that the governors can't be fired by the president once we appointed. It's in the Constitution, and I think it's a very different ballgame. So I think that, smart investors differentiate. You must remember when you're talking of emerging markets, there's so many different ones. There are some like Chile, some in Asia, who are almost like advanced countries. They're the zero low bound. There are some, who are highly volatile. There are others, who have, we're often in the company of Turkey, Brazil, and Russia, but some of our institutional structures are very different. Our kind of debt profiles and our vulnerabilities are very similar. But I think that's the reason people don't just say, sometimes it's an emerging market. All emerging markets lose out in the exchange rates. Tomorrow, if Fed yields US yields went up again, all emerging markets would suffer. But in the Turkish thing, it's about differentiating. Oh, this country has very serious institutional slippage. We question the credibility of its macroeconomic institutions, and it's treated very differently in South Africa. Thanks.
Just to the audience, we only have one question so far. So I think I'll pose that question to you, Kevin. You were speaking about vaccines earlier on. Is there any chance that the South African government will allow the private sector to purchase vaccines and distribute to employees, clients, etc., medical aids and the like?
So the problem right now is that the pharmaceutical companies are only dealing with governments. It's not as if other countries are doing private sector deals and we are not. The pharmaceutical companies that produce the vaccines have set up an order book, and those order books are with governments, and they've made that on purpose their priority. And most of those order books are 100% full. There's very little spare capacity in terms of the existing order book. That's what makes it difficult. It's not a question of, well, let's get more vaccines, let's go out, we'll spend the money, buy the vaccine. The problem is there isn't the available supply in terms of the production process, which means the countries that placed orders very early, Canada would be a good example, they've got more than enough supply. Other countries that place orders much later, South Africa, we are near the back of the queue. And it's not as if the government is making a choice, we're not going to buy vaccines, and we're stopping the private sector. That's nothing like that's happening. It's that there isn't available supply. Now, it'll change, right? Don't think of this as cast in stone, because if you take, for example, Canada, they placed orders for 5 times as many vaccines as they needed. Because when they placed the orders, they didn't know which companies would produce successful vaccines, so they just placed lots of orders. Now, clearly, Canada will be canceling some of those orders, and there should be production capacity then more evenly spread. It's possible the US will find itself in the same position. It's also possible, or very likely, that China has a lot of capacity that isn't being spoken for right now. So I think you've got to see it as a fluid situation. It's going to evolve. And I think that over time, more vaccines will be available. And I think at some point, the private sector in South Africa will be very heavily involved, at least in distributing. South Africa's actually got the potential of a very substantial distribution network. If you think about pharmacies, if you think about Clicks, Dis-Chem, all your little clinics, there's a huge potential to distribute. So our problem right now is getting the vaccine, and it's a global supply problem.
I've got some more questions coming in here, some interesting ones. So I'm going to go to the questions. I think when we look at where South Africa is now, one of the solutions to kind of moving to a better economic position for the country is growth. Because if we get growth, that kind of goes a long way to solving some of our problems. The question here is that yesterday's MPC meeting chose to keep interest rates as is. How is the ongoing electricity supply challenges factored into that decision, owing to the fact that we'll probably be living with widespread blackouts for the foreseeable future? So I think, Rashad, a question for you. Economies don't grow in the dark. Only fungus does. So, do we get any growth without electricity?
Yeah, economists use a term called potential growth, and the term potential growth is basically a way of conveying to what extent can this country grow continuously at a particular pace without needing to tighten through monetary policy in order to prevent inflation from going up. And, we used to say, well, if you think of countries like China, its potential would be 7-8%. If you think of countries like India, maybe its potential is 5-6%. If you think of the average emerging market, the potential growth of those economies are 4%, 5%. We, until I think maybe, around 2007-8, used to think of this economy as a 3% economy. Now we think it's about a 1% economy. And we think it's about a 1% economy, maybe 2%, because of a number of things. One is that, electricity has become more of a supply constraint than it used to be in the past. So it prevents supply of new firms who want to embark on production that are energy intensive. We also take a view that some policy decisions we made over the last couple of years, the effect of the financial crisis, has pushed this economy down. So if you look at our growth rates, our growth rates have been pathetic for the kind of economy we're in, for the kind of unemployment rates we have. And one of the big problems is simply that we have an energy constraint. Now, but the energy constraint becomes much more of a constraint when the economy accelerates. In some ways, we were kind of lucky that we've had this low growth from an energy point of view. But even then, the low growth is partly because of the energy constraint, amongst other constraints. So it's a problem. There's some silver lining. Some firms have moved to kind of less energy intensive development, some green development. So there would be some silver lining from it. There was also, I think, on the one of the questions was around, how does the price of electricity affect inflation? And that's the other side. We increased, one of the reasons why our inflation went up a little bit for 2021 from 4 to 4.3% was partly because electricity prices are going up. And that although, we look through electricity prices, that makes it much harder to bring down interest rates when you feel you can, because of the effect that electricity can have on general inflation. Thanks.
An interesting question for you, Kevin, maybe a tough, really unfair question, is what do we need to do in order to reverse our junk status? How long will the process take? That's a fairly unfair question. And what are the consequences of us remaining in junk? I think that's a much easier question to answer.
Sure. So it's something that I think South Africa should be striving to achieve. I think having an investment grade credit rating is a worthwhile goal, and there are many benefits of it. But when you look internationally, countries that lose their investment grade credit rating and become junk status, they tend to take an average of 8 years to get back to investment grade. Now, the spread around that 8 years is very substantial. So it's not as if it's an absolute, but it gives you some idea of the problem. In other words, it's very difficult to then fix the problem and get the system going in such a way that you convince the rating agencies that you're doing a much better job. And we keep saying that rating agencies are much quicker to cut your rating than to increase your rating. They tend to be fairly cautious from that perspective. And right now, we are generally speaking on negative outlooks. In other words, the rating agencies are saying to us, particularly Moody's, they're saying that if things don't improve, we're going to cut your rating further. So in the short term, there's more risk to our rating to the downside. We've still got to halt the damage. What would go a long way to that is obviously controlling the salary increase. That would be a very key step in government, and then making sure that we can improve generally the way in which government manages their spending, not the job that Tito's doing, but the government departments. But ultimately, there's no other shortcut to economic growth. So in order to really improve finances, you're going to need economic growth, you're going to need employment, you're going to need a bigger tax base. Then we can make a more meaningful, a quicker change. So I would say that in the short term, there's more risk to the downside, then stabilize, then go back up. You probably are looking at 8 years from here in order to get back to that investment grade. And that sounds very depressing. What's good is that once you start to move up, you tend to then get the reward of being at a higher credit rating, because investors start to anticipate that your credit rating will go up further. So it's not as if you've got to wait until your investment grade before you get some sort of benefit. The negative is simple, that it just costs you more. On the whole, countries with lower credit ratings pay more to borrow money, especially internationally. And obviously, South Africa being a low savings economy, we need a huge amount of foreign investment. And we need a perpetual inflow. So for South Africa in particular, it just becomes more expensive. And clearly, the types of things that you would have to put in place to get an investment grade credit rating, while they are what the credit rating agencies want, quite frankly, they're what everybody would want. They're what local investors would want. They're what foreign investors would want. They would make a lot of sense. So we're hoping that we're close to stopping the deterioration, that we can start to see incremental improvements over the next couple of years. And then I think that discussion will come back as to do we start to see upgrades, but it's still a long way off.
Okay. So basically the cost of debt will become a whole lot cheaper if we are able to turn things around and kind of get our credit worthiness, our credit rating back. It's just like your own personal credit rating. If it's too poor, you can only borrow from African Bank, and you're going to be turned down at Standard Bank. And African Bank charges.
It works in a similar way.
Yeah.
It would also make it easier for the Reserve Bank to be more aggressive in cutting rates. If the credit rating was moving up, it gives the Reserve Bank more policy choice. the Reserve Bank is ultimately restricted by the fact that we don't have an investment grade credit rating.
Rashad, a question for you, and I was kind of waiting for this question to come, but yeah, I wasn't disappointed. Fairly topical. Your view on Bitcoin. So you're at the Reserve Bank. The currency and currencies are kind of your forte. Should Bitcoin be considered as an asset or even a currency, and therefore part of an investment portfolio? I can understand if you don't want to answer the investment portfolio side of it, but certainly the Reserve Bank's view on Bitcoin and cryptocurrencies in general.
Yeah, if you listen to my investment advice, you'll probably lose a lot. So, we have I should be better equipped to answer this question than I am, because I'm responsible in the bank for the part that deals with CBDC and Bitcoin and so on. But I am not. But let me just say a few things. There's a lot of definitional issues. I mean, you're talking of cryptocurrency, you're talking of Bitcoin as an asset. We have a few things going on in the bank. We've got a fintech unit. The first thing to say is that on the Treasury website, there is a joint initiative between us, Treasury, and the Financial Conduct Authority in developing a regulatory approach towards cryptocurrency. And the idea behind that is really, at one level, it's kind of logic. The logic is that if money laundering in this country is banned, as it is in every country, we don't care whether you send a telegram or you use a crypto. It's banned. The question, I guess, that the law has to address is what is it? What are the instruments that you are through what instruments are you violating the law? So a lot of this legislation that was written pre the technology. So the idea is not to prevent it, not to promote it, but to make sure that there's a proper regulatory framework to kind of avoid risks to consumers, risk to the economy. The Canadian law and some of the other laws have some interesting things. For example, some law describes trading in if you're using a crypto to buy something, or you're part of a group of retailers who trade crypto, then in Canadian law it's called a barter. It's officially called barter. In some tax laws, they recognize Bitcoin as an asset by you declaring any dividends or any income you've earned. So when you've earned income from Bitcoin at the end of the year, whether there's a tax on it or not, some legal jurisdictions actually you're obligated to kind of file that you've made 100,000 Rand on Bitcoin. So I think that there's a regulatory framework in place. For those of you who are interested in the detail, it's on the website of Treasury. We're quite involved in it and spearheading it in some ways. But the idea is just to kind of regularize, to make sure that we don't suppress, nor do we create unnecessary risks to the economy. We also have something called central bank digital currency, a project around central bank digital currency. And there the aim really is to kind of look at whether cash can coexist with some digital currency, not on the wholesale side, because that already exists. It's on the retail side. So that's more or less what I can say at this stage.
Okay, gentlemen, I'm acutely aware of the time. Looks like we've come very quickly to the end of the hour. So at this stage, I just want to thank everybody that's still on the line for your attendance. And thank you to Kevin and Rashad for offering your time and for the insights that you've given us. I think certainly after seeing Kevin's presentation, I'm perhaps a bit more optimistic going forward, although there are risks, clear risks that do lie ahead in terms of global inflation and the potential impact of rising bond yields in the US and what that means for investments and portfolios. I think needless to say, we do pay a lot of attention to the risk side of things as much as we do to the opportunity side. Kevin, I don't know if you have any closing remarks that you'd like to make, anything that you think the audience could take away from this session.
I think the one thing just to bear in mind is that, or two things. One is the difficulty South Africa is facing with the vaccine and the rollout is a global issue. I think South Africa gets a bad rap for that. I've looked at many countries. We're not alone. Obviously, we don't want to be complacent, but it's a big process for the world to go through. The second is that I think there's a growing level of confidence that the world will enjoy 2 years of above trend growth, and that it can make a meaningful impact, especially if eventually the vaccine is rolled out, and that it's about using that uplift as a catalyst for an extended growth phase. And I think that's the opportunity for South Africa. And that's certainly what we're urging, is use the next 2 years to then set the base for sustainably higher growth and an improvement in our potential growth rate. So I've become a lot more optimistic actually in the last few months, because I think there is some upside. Outside of that, thanks a lot. Thanks for giving me the opportunity.
Great. Thank you, Kevin. Rashad, I think from your side, any...
Yeah, just, one or two things I see that, just following some of the questions. Will the inflation target change? I don't think so. When the governor is always asked the question, will the inflation target change? He says if it changes, it only changes in one direction, and that's going down rather than up. We're quite on the high side compared. Look at Brazil. Brazil's inflation target is 3.75. We had 3 to 6 with 4.5%. I also think that, like Kevin, I think that there's this question about should we do things differently. There's a long literature that has emerged now in the last couple of months about how COVID-19 has rightly created more inequality, and we should worry about that. That people like us gain from COVID-19. We can work within the comfort of our homes. Maybe we get less bonuses. But I think that there is a silver lining for me. I think that the economy is going to become more efficient. I think that lots more, the use of technology like Zoom and so on is going to allow all sorts of economic activity to take place, more fluid labor markets. People can choose lifestyles in Knysna and the Cape and still work, efficiently. So, notwithstanding some of the social impacts that we've got to worry about, I think there will be some silver lining coming out of the COVID-19 experience.
Great. On that positive note, thank you everybody for joining us today. Kevin and Rashad, again, thank you very much for your input. And to our clients on the call, thank you very much for your time. And as always, if you are concerned about anything, do, drop us an email or give us a call, and we'll endeavor to find you an answer or kind of address whatever concerns you may have. So from the team at Gradidge Mahura Investments, thank you all very much and stay safe.